Hey, what's up, everybody? Welcome back to Investing Sucks. So, in this video, I'm going to be taking a look at Snowflake. Now, the reason why I wanted to take a look at Snowflake is because this company has come down in price very significantly recently. And this is a company I've actually been following for quite some time now, pretty much since they IPO'd. And I haven't made a video on them yet, so I figured now that they've come down in price so much, maybe now would be a good time to take a more in-depth look at them. Now, if you were to ask me pretty much at any point in the past since this company IPO'd, what I actually think of this company, I would have said something along the lines of great looking company, but just way too expensive in my opinion. But now, because it's come down so much, it seems to be looking less and less expensive. So in this video, I want to talk about whether or not this company represents good value to investors right now. Okay, so I want to start by quickly explaining what exactly makes Snowflake as a company so special. And I've outlined a few of the key points on screen here, but I'm also going to discuss a few of these points with a bit more depth. So, Snowflake is a cloud native data warehousing platform, right? Which is a lot of jargon, but what that means is they operate entirely out of the cloud. So, they use AWS, Azure, Google Cloud, really the big three cloud vendors, and they offer a data warehousing platform, which is basically a central place where companies can store data, they can query data to look at business reports, they can analyze data, they can do all sorts of things, right? And data is becoming a very, very valuable asset for companies, right? Companies that can extract insights from the data that they collect can learn things about their customers, they can use it to be more operationally efficient. Overall, if they can make good use of their data, it's going to be a big positive for them. So putting a data warehouse in the cloud was a big innovation that Snowflake brought to the market because before companies would have their own server set up, their own architecture set up for storing, processing, doing analytics on the data that they collect. But doing this in the cloud saves a lot of money because now companies only pay for the compute resources, whether it's storage or processing or analyzing data. They're only paying for what they're actually using, and they don't have to worry about capacity planning or investing in all this elaborate infrastructure to manage the data, and then also hiring employees to manage that so they can make good use of their data. And Snowflake does use a pay as you go pricing model. So basically, as customers, it's basically a value based pricing model. As customers are using the Snowflake platform more, they pay more for essentially what they're using, right? And what you see in that is this metric, net revenue retention rate, which is a pretty important metric when you're looking at any sort of software company. It is literally one of the highest you're going to see in out of looking at any software stock, right? Currently, in the most recent quarter, it was 128%. Because what happens is as companies grow and the amount of data that they have grows, they spend more with Snowflake because they're using more compute resources, they're using more storage. And because of that pay as you go pricing model, the revenue is going to keep going up on a per customer basis. Now, another interesting feature that their platform offers is actually this marketplace where companies can literally sell data to other companies, right? So they're not always going to do that. They can decide what data is worth selling to other companies, but they have this online marketplace that enables companies to, literally sell data to each other, which I think is pretty interesting. Now, I could go on for hours talking about all the innovative and the unique things that Snowflake is doing. The main point I want to mention here is that this isn't some ordinary company, okay? This is a company that brought a very innovative and a very unique solution to the market. Currently, 700 out of the 2,000 largest companies in the US are using Snowflake right now. Now, that doesn't mean that they're immune to competition per se, but the fact that they've achieved that over such a short period of time goes to show that this is a very innovative company. So, everything that I just talked about with Snowflake is no secret, right? Pretty much any person that is an investor or is interested in investing in Snowflake is going to know all of what I just talked about. It's pretty basic knowledge when it comes to this company. So, having that basic level of knowledge isn't going to be enough to actually determine if Snowflake is going to be a wise investment over the long term. Because the fact of the matter is, this is a perennially expensive company, right? This is a company that is currently priced for a ton of future growth. As we can see in their price to sales ratio here, obviously this has come down a lot as the company's stock prices come down. Currently, you're looking at about a 14, call it 15 price to sales multiple. But going back even until 2021, there were times where this company was trading at over 100 price to sales, which is crazy, right? There's very few companies that are ever going to be priced at 100 times sales, especially a company that was already a pretty large company, tens of billions of dollars in market cap. Now, granted, that was 2021. Things were very different back then, but even now, right, it's still quite high at 15. If we look at, the multiples for other software companies, right? So these are basically all the other software companies, American software companies here. Price to sales of 15, industry median just under 3, right? Now, a lot of these companies aren't growing as fast as Snowflake, but it goes to show this company is priced very, very aggressively, right? So this kind of begs the question, why is it so high, right? Well, like I said before, it's a very innovative company that kind of has this natural revenue growth driver built in, which is that pay as you go pricing model. So in a way, their growth as a company is tied to the expansion of data, right? And the amount of data that exists within companies and pretty much just exists overall is growing exponentially, right? There's a lot of data out there these days, and this company has a way of basically monetizing that, right? And not only that, but they're operating in a market that is expected to grow very, very fast. For example, this data from Statista shows that global spending on public cloud services is expected to hit just over 1.8 trillion by the year 2029, right? So this is an industry that is growing very fast. Now, Snowflake's financial statements are, I think, very simple to understand, right? So if we take a look at their annual income statement here, going back a few years, the first thing that really jumps out to me is the revenue growth rate, right? In 2019 to 2021, revenue growth was over 100%, right? Which is extremely high. There's not many companies out there that even have the ability to double their revenue on a year-over-year basis for 3 years in a row. And it's kind of tapered off in the more recent years as growth is moderated a little bit, which is probably how things will be going forward for them. But again, that's something that really stands out. The other thing that stands out is massive operating losses, right? I mean, we're talking in the most recent year, they lost over $1 billion. And it seems like every year losses are just getting bigger and bigger, not only, on an absolute basis, but also relative to the size of Snowflake as a company. Right. So when we're looking at a company like Snowflake, it's important to remember, right? You value a company based off of what it's going to be in the future, right? Not based off of what it is right now. And Snowflake currently has a market cap, as we can see here, about $42.5 billion. So a market cap is nothing more than a representation of investors' collective opinions over what a company is worth, which is going to be a function of the future cash flows that they expect that company to generate discounted to the present at a reasonable discount rate, right? So some of these large cost items that we see here on their income statement, like research and development expense, 1.3 billion a year, sales and marketing expense, which is their highest at 1.4 billion a year. These are so large because Snowflake's current strategy is to capture as big of a market share as they possibly can, win as many of those Fortune 2000 customers that will spend millions of dollars with them each year, lock in those customers since all their data is going to be loaded onto Snowflake's platform. And at that point, it'd be very expensive for them to switch to a different provider. And then once you've done that, you cut back on the R&D expenses a little bit, you cut back on the sales and marketing expenses significantly, and you just generate tons of cash flow, right? That is really the model that software companies look to follow. And that's why when they're in growth mode, they're going to look like this. They're going to be running these massive operating losses. It's not because they're dysfunctional businesses. It's just they're reinvesting for the future, right? So you have to value Snowflake with that understanding. And to give you a bit better of an idea of what this is going to look like, I'm going to pull up an example of another company that I'm sure you all have heard of, which is Oracle, right? So Oracle, we can basically think of as a reasonable benchmark of what Snowflake might look like well into the future, right? If we're talking maybe 10, 15, 20 years into the future. Now, some people may not agree with that. I'm not saying that they are the exact same company, but in terms of what Oracle looks like from a financial standpoint right now, I think most Snowflake investors would be more than pleased if Snowflake could look like Oracle in say 10 years time, right? Because if we look at the financial statements, and again, we'll go to the income statement, what we're going to see here is not a whole lot of revenue growth for Oracle, right? Their revenue in 2015 was 38 billion. It kind of had this jump in 2023, but if we look at 2022, 42 billion. So it was really revenue was only growing in the single digits each year and even going down in some years, right? Now, their operating margins are extremely high, right? We're talking mid 30% operating margins. And then in terms of free cash flow, how much free cash flow they're generating? Well, in some years, it's over $10 billion in free cash flow a year. So Oracle is literally one of the most valuable companies in the world, right? So the reason I'm pointing this out is because it begs the question, Oracle is a mature company. It's not growing nearly as fast as Snowflake. So what will Snowflake look like when it gets to its phase in the business cycle that Oracle is in right now? That's kind of how you have to think about this company and how you need to value them. So let's try and answer that question and project what this company will be worth in the future once they are actually cash flow positive. Now, for Snowflake, I wanted to keep this valuation model here simple and just use the multiples method instead of a actual DCF, because with this method, it's pretty straightforward. We could just project out the revenue growth. We take an EBITDA margin based off of what we think their costs are going to look like. And then we apply a reasonable multiple to that, and then we can project what the future returns might be invested in this company. So I'm not going to go through every single assumption that I have, but the main idea is that I have revenue for the current fiscal year, which is 2025, for them being at basically what they guided, which is 3.3 billion, and then I have it growing at 30% per year going after that. So that is pretty optimistic, I'd say. But I also think it's a reasonable assumption because as we saw, their net revenue retention rate was 128%, right? So if that stays constant and then they also add some new customers on top of that, then 30% should be well within range for them. Now, gross margins, I have these. Again, the next year it's going to be pretty much on par with what management has guided, but I have these expanding going forward all the way to 76% by fiscal 2029 for them. And then in terms of the key cost drivers, like I said here, these are going to be decreasing, right? They're going to be decreasing every year because of what I mentioned before. These are growth related costs that get scaled back several years down the line as they continue to capture new customers. The need for sales and marketing declines and also their revenue scales up. So they aren't spending as much on R&D and general admin relative to the amount of revenue that they're earning. So, with all that in mind, we get over here an estimated EBITDA by fiscal 2029 of about $2.2 billion, right? Which implies a 23% EBITDA margin. So then we take that and we apply a 25x enterprise value to EBITDA multiple to calculate what the enterprise value would be. We add the cash investments, we subtract the interest bearing debt, which is very low for a tech company like Snowflake, to get an equity value of $57 billion. We divide that by shares outstanding, which I assumed shares are going to dilute at 2% a year each year. So we have about 370 million shares outstanding. So we get an estimated price per share $154 versus the current price of 127, which is only a 4% annualized return each year over this roughly 4.5 year holding period, which that is obviously awful, right? Now I'm sure any Snowflake bulls that are watching this video probably just lost their minds when I showed how I'm only using a 25x exit multiple here, right? And this is probably where we're going to disagree. Some may think that it deserves a higher multiple than that. And sure, if you just apply a higher multiple to this, like say we use 40, for example, the returns instantly look very good, right? We're talking 15% annualized returns now, right? Which is, we use this multiple, it looks a lot worse, right? So this is a very important decision you have to make projecting this company. Now, one thing I want to show you, if we go to my website here, I want to show you something that I put together, which actually is pretty useful information for when we're looking at software stocks. So what this script does is I'll run this and it generates this. And this is publicly available as well. So if you want to use my website, which is currently free, it's tickernomics.com, and you go to public scripts here, it's just called software stock multiples. So you can search it and you can run it for yourself. But basically, what this does is it returns a list of software companies in the US that have a market cap of at least $1 billion. It shows you their market cap, their three-year annualized revenue growth rate, their current EV to EBITDA multiple, and their current PE multiple, right? So let's look at companies that are growing kind of in the range of 30% annualized per year, and what kind of EV EBITDA multiple do they have? And this is really where I struggle because what we're going to see is quite a wide range of outcomes here. For example, we have CrowdStrike here, which CrowdStrike is a company that it's done very well recently. It's a company that recently became profitable, so their metrics are going to look way out of whack. You can see a 430 EV/EBITDA multiple here. PE is over 1,000, so that's not really that useful. And then there's another company, say Ceridian here, has a 40x multiple here. Intuit has a 14 multiple, Paycom has a 12 multiple, and we can kind of go through the list and see what companies are valued at, that are growing kind of in the range of the high 20s per year. Now, a lot of people are probably going to take issue with this and think these are all different companies. You can't really compare Snowflake to these companies, right? Which is fair enough. But the way I kind of see it, right, is you may disagree with my comparison, but is relying on there being a super high multiple in the future really a wise investing strategy? If you think it is, and you think that's a reasonable multiple, then what I'd want you to consider is that this multiple, right, that you're projecting in the future, this isn't your personal opinion on what the multiple should be. This multiple is the collective opinion of all investors when they're looking at Snowflake, right? Which may be different from what your personal opinion is, right? So when you're looking at this, you have to understand what is reasonable to assume that investors will value this company at into the future. Maybe 40 is more reasonable for you, but me personally, I would rather err on the side of caution and use something that I think is more reasonable, because then I'm not relying on such a high multiple to be able to earn decent returns. Now, also consider some of the risks, right? The biggest risk is going to be that Snowflake cannot capture as big a market share as they'd like to. Maybe there's other formidable competitors like Databricks, for example, which is a very large privately held company. Maybe that company takes some share away from them. And if Snowflake can't win new customers, then their revenue growth will slow down. And this is really the biggest challenge that you're going to have when looking at this company, because it's very, very hard to predict these things, especially if you're just an average retail investor who you don't work in this industry, you aren't keeping up with the latest trends. So yeah, that's my opinion on Snowflake, guys. If you are interested in getting this valuation model here, just send me an email and I can send this to you free of charge. But yeah, those are my thoughts. I hope you did find this useful. If you did, then leave a like. And if you're new to my channel, I'd appreciate if you'd consider subscribing, and I'll see you guys in the next video.